Hello, welcome to our discussion, second half of the discussion, chapter 3, and we're looking specifically at things that are excluded in the tax law, by law, from gross income. Remember, everything's included unless it's specifically excluded. So these are things that are part of that list. Not everything, but we're going to give you some of the main ones. Okay, so the first one that comes into play, because typically everything that our employer provides to an employee is income. Okay, that doesn't matter what it is that they provide. Okay, this became not a real practical situation, so they specifically exclude some what we call fringe benefits. So first of all, they typically have to meet a non-discrimination rule, meaning you cannot provide them for certain employees and not for others. They have to be provided at the same level for everyone, okay? Or in some relationship to their income, but usually same for everyone. Example of this fringe benefit: no additional cost services provided to an employee. So those who work for airlines, most people realize that those who work for airlines can fly on the airline for free without paying for it, as long as they go standby, which means that you only get on that plane if there's room. So that means that it didn't cost the airline any additional money to have you fly on that airplane. They were flying anyway. Okay, the flight was leaving. It wasn't a flight just for employees or anything like that. Same thing can apply to hotel rooms. There's specific rules about it. It has to be in the same business, meaning an airline can offer airline seats. Hotel can offer hotel rooms, but airline can't offer hotel rooms. And even if the same company owns them, if your employee is someone that works for the airline, they can't get free hotel rooms. And if their employee works for the hotel part of the business, they can't get airline seats. Okay, so it has to be in their business. There has to be no additional cost, that sort of thing. Okay, some other examples: discounts provided to employees. So a lot of retailers, if you work for them, will provide you with some type of a discount, okay, for buying the products in their stores that you work for. The discount cannot exceed the gross profit percentage, which means the cost you charge the employee can't be less than what you paid to get it. So if you're going to offer a discount on let's say a shirt, and it normally sells for $20, and you buy it for $10, the lowest price you could charge the employee would be $10. Okay? Any percentage that's less than 50% in this case would be okay. In this case of services where there's no product to have a cost on, okay, the maximum discount can be only 20%. You can provide, say for instance, you don't have parking on your particular premises, or you have a place that's very difficult to get to by car because there isn't a lot of parking. You could provide your employees with either parking or a bus pass or something that allows them to come to work. But it can't be another limit. Okay, so every one of these has limits. Okay, no more than $300 per month, the value of it. So the parking pass, the parking at the parking lot across the street can't be worth more than $300 per month. Anything above that, if the cost of that, we go ahead and we buy a pass for every employee, and the cost is $350. Then the other $50 would be income to the employee. Other de minimis benefits: holiday turkeys, company picnics, extra food, snacks, coffee in the break room. Allow them to make copies on the copier for personal uses, those sort of things. Too hard to keep track of and actually report as income, so they're lumped in here with these fringe benefits so that they can be non-taxable to the employee and still deductible to the employer who's providing them. Another one that is very common and very specific is life insurance. Okay, you provide group term life insurance for your employees, and you can pay the premiums. The employer pays the premiums, and the benefit goes to the employee, but that is not income as long as the coverage is less than $50,000. Any coverage over that, if you offer them, let's say $100,000, then $50,000 of it, the value of $50,000 of it would be tax-free, not included in income, and the other $50,000 would be included in income and put on their W-2. All right, and the IRS provides a whole set of information about what the value of life insurance is based on the age of the employee. So it doesn't really matter what the employer actually pays for the coverage. It is what the IRS has determined the value is. Okay. Education assistance. Very big benefit. 5250 could be reimbursed to the employee. They can take classes on anything. It doesn't have to be related to their job or anything like that. As long as you set up a reimbursement plan and it is non-discriminatory, anybody can use it. They can be reimbursed $52.50 for tuition and books and all that kind of thing to go and take classes. They can also, this was more recent, $52.50 of student loans may be paid. Okay, again, and not included in the income of the employee. Dependent care assistance. They can set up a situation where they pay for the child care while the employee is working. Okay, up to $5,000 can be excluded. It's not income if it is set up as a dependent care assistance program. And it has to go directly to the dependent care company, all that kind of thing, and it cannot exceed the earned income of the employee because we can't offer that to an employee that's making less than $5,000, obviously. Okay. All right, some other non-taxable income that not necessarily have to do with fringe benefits or employees, employers. Okay, scholarships and fellowships are generally not taxable income. When you borrow money for a loan, loans are not income anyway, but student loans are not income specifically. Now, we can run into trouble with some certain fellowships. Sometimes a fellowship requires the student to work, to do certain things. At that point, it's no longer a fellowship or scholarship, it is a job and therefore is income. Okay, so this is when it is just because you applied and you showed need or you had a certain GPA and they gave you a scholarship or a fellowship. Scholarships usually for undergraduate, fellowships for graduate, and there's no work requirement, then that amount is not included in income, not taxable. Take money out of a qualified tuition program. We'll talk a little bit more about this in Chapter 11. Okay, up to $10,000. You take that out to pay tuition out of a particular program. That's not income, not included in income of the student. Okay, life insurance. All right, is usually not income. So one spouse dies and the life insurance pays out the other spouse. That money is not income. If that money earns interest for that the living spouse, that is income, but the proceeds itself are not. Gifts, inheritances are typically not income. Remember, okay, gifts have to be of generosity, not in exchange for something. So we have to be careful that we're not paying for work or something like that, but actually giving a gift or leaving it behind when we pass away as inheritance. So when someone inherits something when grandma dies, that's not income to them. Okay? When grandpa gives a gift, grandchild does not have income. Typically, compensation for sickness or injury. A insurance that pays because you have a particular injury. So sometimes there's this ADD insurance, accident, disability and dismemberment. So if you say cut off your finger, you will get a certain amount of money. That is compensation for sickness or injury and is not included in income. If it pays out so much per day you miss work, like Aflac you hear on so many commercials for, that can be income. Okay, that's not because of sickness or injury. It's because you missed work. It's a replacement for the income and therefore is income. Child support is typically not included in income. Welfare assistance, food stamps, things like that. And there is also a program for employer to pay for adoption, and that not to be included in income up to limits as well. Okay, savings bond interest we mentioned earlier, okay, as kind of a mix depending on what it is used for. Okay, this is savings bond series E or EE, used to save for education. You put money aside now. Okay, when for a child, when they get to reach time to go to school, they take the money out and pay for their college tuition or whatever. Okay, when that happens, is the interest income or not? Okay, if all of the amount that you take out, you redeem the bonds for, including the amount you originally received, that was originally put in, and all the interest, if you use it all to pay education expenses, no income, okay? And it has to pay for qualified education expenses for the taxpayer, spouse, or dependent children. Definition of child we learned back in chapter 1, okay? Important in this case, the situation. And if you're AGI, a phase out. We mentioned earlier in chapter 2 about phase outs. This is one when your income exceeds $37,800 on a joint return and everybody else $91,850, then part of it can be income and part of it still phased out until at a certain level, all of it will be income and none of it will be excluded from income. So the benefit goes away as your income increases. Okay. We have a loan with a rate lower than the market rate. We have to require to include interest on that, even though it wasn't paid. Okay. If it had to do with the sale of property for $3,000, okay, we don't worry about it. If it's all the payments are made in 6 months or less, it's not long enough to matter. Okay, so we don't want to get everybody. Aunt loans you money to buy something. Okay, you buy it from your aunt, and instead of paying her, she essentially gives you a loan to buy it from her. Okay, that for $3,000 less, we don't worry about it. Okay, if all the payments to the aunt are paid in 6 months, we don't worry about it. Okay, if the loan is for over $17,000, then we have to worry about imputed interest. Okay, and that is, say, the case whether you actually pay it or not. Let's say, for instance, aunt gives you a loan for $20,000. And then, and it's signed and there's interest mentioned and everything like that, okay, in the loan. But every year she just says, never mind about the interest. That's my Christmas gift to you. You don't have to pay interest. That is still interest. That interest that is forgiven, okay, is that interest to her is still income imputed, even though she forgave it in the form of a gift. Okay. The other complicating factor is original issue discount. This is where you borrow money, let's say which is how a lot of bonds work, but you borrow $800, okay, but at the end of 5 years or 10 years or whatever, you pay back $1,000, okay. So that difference between 800 and 1,000 is what's referred to as the original issue discount. If you are the one that is owed the money, so you loaned someone money, $800, and they're going to pay you $1,000 back, that $200 of interest has to be reported as part of income each year, a little bit each year till you get up to the full $200, okay? And it has to be done based on the rate that would be normally charged in those cases, okay? This does not apply, so it's a little bit of a complicating factor. Typically, when you do it with a broker or as part of your investments, the broker account, your Charles Schwab or E-Trade or whatever account will figure this out, tell you how much you need to report each year. Okay. Doesn't apply to tax-exempt debt, so those that are issued by state or local governments, U.S. savings bonds, which all work on because you have different rules to apply to that. If it has a maturity of 1 year or less, so that short-term thing, okay. If it happened before 1984, which is a long time ago now, okay, and if it's between two natural persons for $10,000 or less, we're not going to worry about the OID.